Hey there. Have you ever wondered about the world of financial markets? You know, the places where people buy and sell things to make money. Today, we're going to dive into two of the most talked about markets. The stock market, specifically focusing on Forex, and the exciting, often unpredictable world of cryptocurrencies. By the end of this video, you'll have a clear understanding of the key differences between these two, and you'll be able to talk about them with confidence. Think of me as your friendly guide. We're going to explore these topics in a way that's easy to understand, using analogies and examples to make everything click. So let's get started. First up, let's talk about the stock market. Now, the stock market is a huge umbrella term, but for our comparison today, we're going to focus on a specific, massive part of it, the foreign exchange market, or Forex. So what is Forex? At its core, it's the global marketplace for exchanging national currencies. Think about it. When you travel to another country, you exchange your home currency for the local one. That's a Forex transaction. When a company imports goods from abroad, they need to pay in the seller's currency. That's also Forex. The Forex market is the largest financial market in the world, by a long shot. We're talking about trillions of dollars traded every single day. To put that in perspective, it's about 20 times larger than the global stock market. This massive scale means it's incredibly liquid, which is a fancy way of saying you can always find a buyer or seller for your currency. It's also a 24-hour market, open 5 days a week, because it operates across different time zones around the globe. So to recap, Forex is the global market for exchanging currencies, it's the biggest market in the world, and it's open almost all the time. Got it? Great. Now, let's shift gears and talk about the new kid on the block, cryptocurrencies. What are cryptocurrencies? Well, the most famous one is Bitcoin, but there are thousands of others, like Ethereum, Ripple, and Litecoin. Unlike traditional currencies, which are issued by governments and central banks, cryptocurrencies are digital assets designed to work as a medium of exchange using cryptography to secure transactions. The key innovation here is something called blockchain technology. Imagine a digital ledger, or a book of accounts, that is distributed across a vast network of computers. Every transaction is recorded in a block and added to a chain of previous blocks. This makes it incredibly secure and transparent. So cryptocurrencies are digital, decentralized, and secured by cryptography. They are not controlled by any single entity, like a government or a bank. This is a fundamental difference from traditional currencies. All right, we've got a basic understanding of both. Now let's get into the nitty-gritty and compare them side by side. We'll start with one of the most important factors, volatility. Volatility refers to how much the price of an asset fluctuates over time. Think of it like a roller coaster. A highly volatile asset is a steep, fast ride, while a less volatile one is a gentle, predictable one. In the Forex market, volatility is generally considered to be low to moderate. Currency pairs like EUR/USD or USD/JPY might move a fraction of a percent in a day. This is because the market is so large and liquid, and central banks often intervene to stabilize their currencies. Now, let's look at crypto. The volatility here is on a whole different level. It's like a super fast, loop-de-loop roller coaster. It's not uncommon for a cryptocurrency to gain or lose 10, 20, or even 50% in a single day. This extreme volatility is due to several factors. The market is much smaller, it's still relatively new, and it's heavily influenced by news, social media, and speculation. This high volatility means there's potential for huge gains, but also for huge losses. It's a double-edged sword. Next up, let's talk about when you can actually trade. This is a pretty straightforward difference. As we mentioned, the Forex market is open 24 hours a day, 5 days a week. It starts in Sydney, then moves to Tokyo, London, and finally New York, creating a continuous trading cycle. This means you can trade Forex almost any time you want, from Monday morning in Australia to Friday afternoon in New York. It's incredibly convenient for people in different time zones or with busy schedules. Now, what about crypto? Well, cryptocurrencies are traded on exchanges that operate 24 hours a day, 7 days a week. That's right, you can trade crypto on weekends and holidays. This always-on nature of crypto markets is a big draw for some. It means you can react to news or market movements at any time, day or night. However, it also means there's no break, from the market, which can be mentally taxing for traders. Let's move on to accessibility. How easy is it for the average person to get involved in these markets? For Forex, you typically need to open an account with a Forex broker. These brokers are regulated financial institutions. You'll need to provide identification, and there's often a minimum deposit requirement, which can range from a few hundred to a few $1,000s. So while it's accessible to many, there are some barriers to entry, like the need for a regulated broker and a minimum deposit. Crypto, on the other hand, is incredibly accessible. All you need is an internet connection and a smartphone or computer. You can open an account on a crypto exchange in minutes, and often you can start with as little as a few dollars. This low barrier to entry is one of the reasons crypto has exploded in popularity. It's democratized finance, allowing anyone, anywhere to participate. However, this accessibility also comes with a downside, which we'll discuss when we talk about regulation. This brings us to a very important topic: regulation. Who's in charge? The Forex market is highly regulated. In the US, it's overseen by the Commodity Futures Trading Commission, or CFTC. In the UK, it's the Financial Conduct Authority, or FCA. These bodies set rules to protect investors, ensure fair trading practices, and prevent fraud. This regulation provides a layer of safety and trust. If you have a dispute with your Forex broker, there's a regulatory body you can turn to for help. Now, crypto is a different story. The regulatory landscape is still evolving and is very fragmented. In many parts of the world, it's the Wild West. There are very few rules, and what rules do exist vary wildly from country to country. This lack of regulation means there's less consumer protection. If a crypto exchange gets hacked, or if you fall victim to a scam, there's often no one to turn to for recourse. This is a significant risk that potential crypto investors need to be aware of. Let's talk about liquidity. We touched on this earlier, but let's define it more clearly. Liquidity is a measure of how easily an asset can be converted into cash without affecting its price. Think of it like a busy highway. A highly liquid market is a highway with lots of cars, so you can easily get on and off. The Forex market is the most liquid market in the world. With trillions of dollars being traded daily, you can always find a buyer or seller for any major currency pair. This means you can enter and exit trades quickly and efficiently, with minimal price impact. Crypto liquidity is a mixed bag. For the largest cryptocurrencies, like Bitcoin and Ethereum, liquidity is quite high. You can buy and sell them easily on major exchanges. However, for smaller, less well-known cryptocurrencies, liquidity can be very low. It's like a quiet country road. You might have trouble finding a buyer or seller, and your trade could significantly move the price. This is known as slippage, and can be a major issue for traders of smaller coins. Now for the part everyone wants to know about: the potential risks and rewards. In Forex, the potential rewards are generally more modest, but so are the risks. Because volatility is lower, you're unlikely to double your money overnight, but you're also unlikely to lose it all. Many Forex traders use leverage, which means borrowing money to increase their trading power. This can amplify both gains and losses, so it's a tool that needs to be used with extreme caution. In crypto, the potential rewards are explosive. We've seen stories of people turning a few $100s into millions. But the risks are equally explosive. The high volatility means you could lose a significant portion of your investment in a very short period. There's also the risk of hacks, scams, and regulatory crackdowns. It's a classic high-risk, high-reward scenario. For some, the potential for life-changing gains is worth the risk. For others, the stability of Forex is more appealing. It all depends on your personal risk tolerance. Let's quickly summarize the key differences we've covered. Forex is a massive, highly liquid, regulated market for exchanging currencies, open 24/5, with moderate volatility and more predictable returns. Crypto is a newer, digital, decentralized market, open 24/7, with extreme volatility and the potential for both massive gains and massive losses, operating in a less regulated environment. So, which one is better? The answer is, it depends on you. It depends on your financial goals, your risk tolerance, and how much time you're willing to dedicate to learning and trading. My advice? Do your own research. Start small, and never invest more than you can afford to lose. The world of finance can be incredibly rewarding, but it's also full of pitfalls for the unprepared. I hope this deep dive has been helpful. If you have more questions, feel free to leave them in the comments below. Thanks for watching, and I'll see you next time.